one thing that I just warn with options is that make sure that you've got an understanding of how options work. Just blindly following any option alert from whether it's me or whether it's from Andrew Keane or whether it's from any because I mean these guys all know what they're doing, but have a knowledge of what your risk reward is and how you're managing the position. I have seen more traders get wiped out by the market because they were improperly trading options than anything else, maybe except futures. And a lot of the time, I hear the comment, well, I have to trade options because I have a smaller account and things like that. It's fine, but do it right and make sure it's always within the realm of your risk management profile. So a general rule amongst traders is to never risk more than 2% of your capital in any one trade. So I mean, just to do the math on that, let's say that you had $10,000, and so your 2% of your portfolio would be $200. So that way, therefore, if you were looking at how much you might allocate, if you were going to follow that rule, and said, well, I'm not going to risk more than $200 on any given trade, that would mean that your stop loss on any trade would not be a loss of more than $200. It would mean that if the option trade went against you, you'd be trying to plan around not losing more than $200. So I mean, if we look at something like FNSR, just to give you a little idea on how you could look at that, let's say your stop criteria is at 28 bucks roundabouts, right? So that would mean that if it went up from where it is currently at 25.69, you would be $2 against you, right? So if you bought a $26 put and it went up $2, you would be $2 against you. So just to give you a rough idea of how you could quickly estimate what that would be worth, there are option calculators built into trading software and so forth. But another real easy way to do it, just to get a general idea, is look at what an option currently costs. What's the difference if it was $2 against you now? So we could say, look at what does a $24 or $23 put look like now? So we can go back to this and say, okay, well, 26 is close to in the money. So if we go back and look at let's say a $23 put, right, which is kind of like looking at an estimate of how much the difference in cost would be if an option put went against you. You can see that we're looking at a difference of about $1.25 versus $2.15. So immediately what I would go into that with is the idea of, okay, so based on a June put where your risk is going to be roughly $2, I would be assuming that there's going to be taking on about a 50% risk. So therefore, if you're thinking about capital allocation, again, these are just general ideas, but that would say, okay, based on a $10,000 account, the most that I'd be willing to put into that would be, say, $400, because then that's going to be a $200 risk. Again, these are rough guidelines and not to be considered as financial advice, but just giving an idea of how you can start thinking about the way you go about trades. Does that make sense to everybody? Because I think that when we start talking about options, yes, they can be very exciting, but make sure that you're not setting yourself up for disaster by not managing them properly, or not following your stop loss rules, or investing too much, because these are often ways that people do go bad quickly. And